I belong to you.
Again, for those of you who don't know me well, my name is Chad Helmcamp with BWC Lending. I started BWC Lending about 3 years ago, and we have slowly but surely grown over that time frame. And in my years in the mortgage business, I've been doing this about 20 years. The one thing I've learned and discovered is taxes always create a lot of questions. And so each and every year, I get lots of questions from both real estate agents and clients about taxes. How do you file them? What documentation do we as the lender need? And I just figure somehow, some way, we need to start doing a little better job of educating our clients and realtor and referral partners about income taxes. And who better to do that than my CPA, Stephen Schoppe, who is on this call here with us. Stephen is a dear friend of mine. I've known him since I was very, very young. He's just a few years older than I am. I won't say how much older. But Stephen's been doing my taxes for years. We've got a great relationship. And my goal today is to have him talk a little bit. He's going to talk to you a little bit about how you can file your taxes as a real estate agent. There's a handful of ways you can approach it. And he'll give you some kind of best practices and things like that to avoid. When he's done with his part, I'm going to take over and then kind of show you a couple of samples of how we view tax returns and how we calculate income on our side. The most common thing that we come across in our world when working with agents and clients is we hear the words, I made X last year. And X is very oftentimes a revenue number, which is usually probably your commission report that you may have received from your whoever your broker is, but it doesn't factor in the expenses. And we as the lender are typically going to be taking those expenses, backing those out, and that's what we're going to be using for income purposes. So there's my overview. Again, Stephen Schoppe with Schoppe and Associates. I'm going to turn it over to you, Stephen. Please introduce yourself, tell them who you are, what you do, and we'll go from there. And I'm going to make you the host so you can share your screen.
Okay.
All right.
Okay. Yeah, like Chad said, my name is Stephen Schoppe. Been in practice for on my own for 25 years and several more years before that time with some other firms. My practice is very broad-based. We do a lot of, we don't specialize in anything. It's just kind of like a general practice, all kinds of clients, construction, service people, you name it, we pretty much do it. We do taxes, bookkeeping, financial statements, payroll, kind of anything you would do. So hopefully we can answer any questions that you have. And part of this thing today was kind of just, telling you, it's going to be very basic. And if you have any questions, you can obviously ask me or get in touch with me. But kind of just some things that we feel is important to tell realtors that sometimes they're missing. When we do their tax return, and we work with Chad as well to, get people qualified for lending. So I'm just gonna start a short slideshow that we had prepared. I'll kind of go through this just on a basic level. And can everybody see that?
Yes, sir.
Okay. So, the first one is choice of entity for realtors. And I don't know, what everybody has is how they're operating. Sole proprietorship, is the most easy way to do it. The next step would be some people are getting an LLC and then practicing as a sole proprietor, which is really no different than if you're a sole proprietor without an LLC. And then a lot of people lately have been electing S-Corp status from their LLC. And, each one of them has their own advantages and disadvantages, as you can see there. Sole proprietors is very easy. There's no separate entity involved. So there's no separate tax return involved. There's no payroll, things like that. So it's the simplicity part of it that gives you the advantage on that side. If you go to an LLC with electing S-Corp status, there are some opportunities where you could save some tax dollars on that. You're just going to a little more complex situation. you'd have to file a corporate tax return, payroll returns, things like that. So like I said, there potentially could be tax savings. It kind of depends on where your income is falling, whether you wanted to choose the S Corp status or not. But that's always something that you might want to keep in the back of your mind. And like I said, in the realtors that we're dealing with, more and more oftentimes, that's the way people are going. The next kind of deal is whatever entity that you choose, whatever do it is, is a good record keeping. A lot of people do QuickBooks Online. There's some advantages to that. Basically, your QuickBooks gets hooked up to your bank accounts. All the information is downloaded into your QuickBooks. Either yourself or someone like my firm or another bookkeeping firm will go through that, put everything where it needs to be, so at the end of the year or quarterly, you would know where you were at, and to make estimated tax payments, those type of things. But whatever you do, definitely get a different bank account for your business, and I would suggest getting a separate credit card for your business. So if you had no other records, when the IRS looks at your information, the first thing they're going to do is they're going to pull your bank statements and go through all the deposits and withdrawals. And so there is, in essence, your records. So whether you're running an accounting program or not, that is your records. And the same thing on your credit card statements. Like I said, that kind of has become QuickBooks has kind of become the standard for that. And since they went online and kind of perfected that several years ago, that's what most small businesses using these days.
Hey, Stephen.
Yes.
Quick question for you. Do you have like a sort of I'm sure it's different for every situation, but is there kind of like a line in the sand you would draw as to when you think a realtor really should start thinking about filing as an LLC S Corp? Like, if a realtor's making $50,000 a year or 100 or 150.
Yeah, there's no set in stone number, but you probably want to be, at least in the, probably on the low end, 130 or 140, around that range, to where potentially you could have some tax benefits on that side. And I'll touch a little bit more of that later depending on if you went the S Corp, there's an issue called reasonable salary, and that kind of coincides with this 120, 130 number in there that most people would probably consider looking at that point in time.
Got it. Okay.
And then the only thing I wanted to create is, a very big issue with not only realtors, but all business that you deal with is, running personal expenses through your company. If you're a sole proprietor, it doesn't really matter a whole lot, because whoever prepares your return will split those out. But if you're running everything, for example, business and personal through your QuickBooks, someone's going to have to go through there and determine, hey, are these personal expenses and non-deductible versus are they company? So plus you get into there's just some issues with commingling of funds that you don't really want to get into if you don't have to. So I would suggest keeping business and personal separate as certainly as much as you can. We'll go on to the next slide here. A lot of people ask, what can I deduct? And it's from my end, it's a simple thing. Anything that's business related is really deductible. And what we usually see in practice is that people, they try to do everything, like I just mentioned, including personal expenses and those types of things, or they limit themselves because they do not think things are deductible. So, our goal is to take every legitimate deduction that you possibly could. So there may be things that you may not think are deductible. The good thing when you do have whether you're self-employed or you have an S Corp or anything like that, you're potentially able to turn some personal non-deductible expenses into business expenses. And some things that sometimes people get missed are, phones and computers and, your phone bills and things like that. Those should all, because you're out and, you're basically on call all day long with your particular business, just make sure you take care of all those things. Home office is another thing I think that we'll touch on a little bit later on. Oh, on the next one, actually. That's something, things that sometimes people don't pick up. Again, that's not a, some people think that's a red flag. It's really not, to be honest with you, especially nowadays, you know, post-COVID or still in COVID to some degree. A lot more people are working at home now, so a lot more people have a home office. And depending on what type of entity you have is how that's handled on your tax return. So again, sole proprietor is very easy to do. If you do have an S corporation and you're running through a home office, you want to make sure that you reimburse yourself those home office expenses at some point in time during the year. And you know, another thing that I'm sure everybody's aware of, but auto expenses are usually a really big deal for realtors, just for the fact that I know a lot of you just drive miles and miles for the job. So it's very important to keep all those records, whether you use a standard mileage rate or you're tracking actual expenses. You'd really want to have some kind of app. Most people do it on the phone, as to what your business miles are versus your personal miles and just total miles. One other thing, if you do establish a home office, theoretically, anytime you leave your house, you've created business mileage. So that's another kind of thing that we like to create the home office categorization if we can, so that you're converting those miles to mostly business. There is a thing, as you can see in here, purchasing of a vehicle can have some big tax savings to self-employed and S corps. And there's a rule, kind of a quirky rule, but if you buy a vehicle with a gross vehicle weight of 6,000 pounds or more, you're able to qualify for a special depreciation. It's called bonus depreciation, and you can actually, I'll give you an example. If you bought it's usually really mid to full-size SUVs. If you look on the door of that vehicle, always do that before you buy it if you're going to do this, and make sure that it has a gross vehicle weight over 6,000 pounds. You can find a list online for vehicles that qualify for that as well. But for 21 and 22, if you bought, for example, a $50,000 SUV that qualified, and you used it 100% for business, you'd be able to take a $50,000 year one depreciation deduction for that particular vehicle, whereas normally that's depreciated over a 5-year period. So, this is one of those things that you kind of look at. You can't do it, obviously you can't do it every year, but, every third or fourth year, it's something that, you might just keep in the back of your mind. I kind of do that myself, to be honest with you. I know some people, lease their vehicles, and obviously you're getting to take the lease deduction at that point in time. But sometimes it's just better to buy it, get a big tax deduction in 1 year. Then you do have to keep track of all your actual expenses for that if you do depreciate it. So gas, insurance, any repairs and maintenance, all that kind of thing. But like I said, it can give you a really good tax benefit in a year if you choose to do that. And I don't suggest going buying a vehicle just to get this tax deduction, but if you're in the market for one and you've kind of been thinking about it and it can give you a tax benefit, it's certainly something that you want to look at. So I would just, that's again, and again, depending upon if it's a sole proprietor versus an S corp, which is usually the case with realtors, you just have to make sure that it's handled the correct way in either of those two entities to get the deductions correctly. Let's go to the next one. A couple of quick things just I wanted to mention as well. Meals for if you're entertaining clients, for example. Traditionally, those have all been 50% deductible. So if you go out with a client and you spend $100 on a dinner, only half of it is deductible. Those were the normal rules. Due to COVID and some legislation that they put in, they were trying to encourage people to go back out to restaurants. So for 21 and 22, if you have those meals with clients or if you're traveling, those meals are 100% deductible for these 2 years, which is a good thing. The only thing there's always a give and take in any tax legislation. And when the 2018 tax laws came into play, they pretty much got rid of entertainment expense. So, for example, if you take someone to a ball game, an Astros game, for example, you cannot deduct the tickets that you purchased, but for 21 and 22, if you bought them food while they were there, you would be able to deduct those costs. And this is usually a thing. There's a lot of people have to do entertainment. I would still say if your business has to do that and you don't get the deduction, sometimes you still have to do it. But and these rules could change. It depends kind of who is in Congress at the time as to how tax law is written. It used to be deductible. It hasn't been since the new tax law came into effect. So that's subject to change. But for right now, entertainment is not deductible. So just keep that in mind. The next one is gifts. And again, I know that, again, this applies to realtors a lot. The IRS sets a limit on gifts of $25 per person, which of course is extremely low. Whenever we do someone that's a realtor, they almost always have way more than $25 per gift. It's our job to tell you what the rules are, and so that you would know that some people still take the full deduction, some people don't. That's kind of on whether they're more aggressive or passive on their tax returns. But there's some other things that people do. For example, taking someone out to eat when you close a deal may be better than getting them a gift, because especially now in 21 and 22, that would be 100% deductible rather than only 50% deductible. So if you took a client out after a closing and you spent $200 on a meal, that $200 is definitely better than the $25 gift limit that the IRS is putting on that gift transaction. So again, just something to keep in mind. Another big thing, and I don't know how many people have it or not, if you're self-employed or if you're an S corporation, health insurance that you paid is handled differently, but you want to make sure that you definitely pick it up on your tax return. And there's some quirks involved in that, whether, if your spouse is covered by a plan at work and you're self-employed and you have a plan, it may not be deductible. So there's, like I said, there's some quirks there. If it is deductible, and you're a sole proprietor, Schedule C person, it's not deductible against your self-employment income and your self-employment income tax, which you have to pay, unfortunately. But you do get to deduct it on your tax return, which is great. So benefit is not as great, but it's still there. If you have an S corp and you have health insurance, again, very important to make sure that's deducted. And there's a quirky way that you have to do that, and you have to include the premiums that the company paid for you on your W-2, and then you're able to deduct it on your personal tax return as well. So again, if you have those kind of expenses, make sure who's ever preparing your return is taking those the right way, or the IRS can deny that deduction. The next one here is travel. Again, you'd want to make sure that it's business travel, and there's again some quirky rules about business travel, whether it's in the U.S. or outside of the U.S., number of days traveled. There's very specific rules related to that. But again, it has to have a business purpose. It says that you need to keep receipts for every lodging expense and travel expenses over $75. And a lot of people ask, hey, is my credit card statement good enough for a receipt? The IRS says it's not. It really kind of depends if you got audited, the personality of that auditor, to be quite honest with you, and how far they wanted to push that. I've seen in practice sometimes, auditors are fine with credit card statements. Sometimes they wanted the actual receipts. So again, I'd probably keep all the receipts that you could, especially with phone apps now that you can just, take a picture of the receipts and it stores it all in one place. It's very easy to do. And if anything ever came up with the IRS, you would have that documentation necessary. Then kind of going back to, I just want to touch on this, and if you are an S corp, you have to pay yourself what's called a reasonable salary. And there's no definition of reasonable salary, but the IRS requires it. I'll give you a court case that I think happened in 13. There was a realtor, and he had about $235,000 of income that he earned for a year. So that's, that's after all his expenses. He netted like 236, but he did not pay himself any salary. And if you are an S corp, you have to pay yourself salary. So the IRS came in and said, hey, you didn't pay yourself any salary. We're going to convert some of this 236 distribution that you took to salary, and you're going to have to pay payroll tax on it. So the IRS did their work. They hired some analysts to come in and come up with what they thought was qualified salary, a reasonable salary for that. And that turned out to be a little over $100,000 that they said that the taxpayer was responsible for paying payroll tax on the $100,000. So again, going back to earlier, what you asked me, Chad, about the tax savings of when you go to sole proprietor to an S corp, that's part of that flow as to where if the tax savings achieved in an S corp, or the fact that you're not paying payroll taxes, that you're not paying self-employment taxes on some dollars when you're self-employed, Schedule C, when you go to an S corp and you pay yourself a salary, and you determine a reasonable salary, there can be some tax savings there. And it's basically the Social Security Medicare portion, which is about 8%. But again, you can't just say all my dollars were in an S corp were, where you can't have an unreasonably low salary. You technically can't have an unreasonably high salary either. But the tax savings comes in as normally people would say, hey, I only paid if let's just say someone earned $150,000, they declare $50,000 of wages and $100,000 is coming out to them, and it's not getting taxed for self-employment tax, which it would be if you were a sole proprietor. So that's where the tax savings can come in. Again, if you do that, and if myself or someone else is preparing your return, make sure that you're getting them to talk about a reasonable salary, so that you don't have issues with the IRS down the road. And there's various methods for determining salary. That court case just provides some precedence for that, which is, and like I said, it's a 2013 case, which is good. It's not too old. A couple other things. As part of the 2018 tax legislation, there's something called qualified business income deduction available for sole proprietors and people that are in S corps. And what they were trying to do was, the corporate tax rate went down from a high of 35% to 21% if you're a corporate taxpayer, which is a schedule, what they call a C corporation. Well, in order to make it fair to self-employed people and S corp people, they gave us this qualified business income deduction. And so it's basically a 20% deduction, and it's handled differently depending upon whether you are an S corp or whether you are a sole proprietorship. And there are some income limitations on that. If you're single and you're over probably low 200s, some of that may be disqualified. If you're married, filing jointly over in the mid 4s, you could potentially lose out on some of those deductions. But if you're under those levels, it is a great tax benefit. So again, who's ever preparing your return, make sure they're taking this qualified business income deduction. A couple other things, retirement accounts. Again, it's another way to, if you're trying to get a large tax deduction and fund your retirement, which unfortunately we see a lot of people that are making dollars and they're not contributing to a retirement account. So first of all, I would say if you're making dollars, start somewhere with some kind of retirement account, whether it's just a traditional IRA, Roth IRA, anything like that. But if you have significant dollars, either in an S corp or sole proprietorship, there's retirement plans that you can get some pretty big benefits out of. One of them is an SEP plan, where you can get mid 50s into that into your retirement account. I think this year is $57,000. You could, depending on how much money you make, you could get that into your retirement account. Another one is a solo 401k, basically getting the same deduction. But those are two things that, again, if you're trying to get your taxable income down, this is something that you definitely want to look at. The next thing is estimated tax payments. Again, whether you're a sole proprietor or an S corp, even if you're S corp and you're paying yourself payroll and you're paying all the payroll tax, you're still going to be a portion of your income probably that you did not take out as salary, and that's going to be subject to tax. And you want to make sure that you're paying something in on, and those payment dates are April, June, September, and the following January, so that when you go to prepare, and they don't shock you and tell you that you owe, $20,000 and you weren't prepared for it. Again, if you have a professional that is looking at your books or helping you quarterly, they can help you tell you where you're at so that you would know what your estimated tax payment would be, which is kind of like what we do for a lot of our clients as well. So anyway, just keep that in mind, because again, my worst thing is at the end of when I do someone's tax return, I might tell them they owe large amounts of tax and they have no idea that they should have been, first of all, saving it, and secondly, send it in. So first of all, I'd say, for most self-employed people, you're gonna be in the 20 to 25%, whatever you make after your expenses, you're gonna be paying 20 to 25% of tax on. So even if you don't make estimated tax payments, at least save 20% if you can, so that when tax time comes, you will have the dollars. And the S corp is a little bit different, but again, make sure that you're saving for the income that's not taken out in salary. And then the last thing I wanted to mention, a lot of my realtors don't like this fact, but it is what it is, and that if you pay anyone, to help, cleaning or staging or anything like that, if you pay someone that provides services over $600 or more, you really should send them a 1099. There's penalties involved if you don't send them the 1099. Chances are you'll still get to take the deduction, whether you send them the 1099 or not, but the IRS tells you to send the 1099, and you really, if you want to avoid a hassle, I would highly suggest doing that, because like I said, it's proof that you paid someone. And I know a lot of times the people will say, well, if I get it 1099, I'm not going to do the work or whatever, but that's obviously always an issue. But as many times as you can get those people 1099, I would I would definitely suggest doing that, because like I said, the IRS can come in and there's definitely penalties for not filing one. So again, that's kind of, I wanted to limit to about 30 minutes. That's kind of my part of it. And again, I don't know if Chad, we're going to open for questions or just.
Yeah, absolutely. And I'll piggyback just for a second, because you mentioned a couple of things there at the end that or a few things I really wanted to highlight about what you talked about. Probably the number one thing that you mentioned, and I'll just say the best practice I created when I started my company was hiring someone like you to do my books for me, right? And so Stephen Schoppe does book preparation, so he can handle your expenses on a month-to-month basis. So that way you do have a true understanding of what you really are earning and what your taxable income is going to look like. It's really nice for me now to have my QuickBooks up to date on a month in, month out basis, so I can manage what first of all, I know if I'm profitable or not. I know if I'm losing money or not. And I can also start to figure out what my tax liability looks like. I've obviously been looking at these types of things for a very long time, so I understand it maybe a little better than some folks, just because I look at tax returns every single day. But one thing I'll really mention is, as he was talking about paying quarterly taxes, I can't stress enough how important paying quarterly taxes is. It's on my calendar every year, or I'm sorry, 4 times a year to do it. And I have a general idea, because my QuickBooks are always up to date, I have a general idea of what my taxable income looks like. And so, and some people, I know a lot of self-employed people as well, and they're always like, oh, I don't want the IRS earning interest on my money. Well, in my opinion, I'm always in debt to the IRS. So I sort of like the idea of knowing that when my next tax bill comes up every quarter, that if I'm a little over, oh, well, it's no big deal, because in my mind, I'm always going to be, hopefully closing more loans, and therefore I'm going to owe more taxes. And so if there's one entity I don't want to be in debt to, it's the IRS. That's my philosophy. And it's nice because I think last year, Stephen, when we did my taxes, I think I had a little bit of a refund, which it wasn't huge, but it was a little bit. Well, that's nice. That was just a little bit less I had to pay on the next quarterly tax bill. And so I appreciated that. That was good.
Yeah, and most, if you are self-employed or you do have an S corp, chances are you're going to owe tax. So just to piggyback on what you said, it's kind of like you said, it's gonna be there, and you certainly want to know. My thing is, I don't like surprising people. That's the worst possible thing. So yeah, I agree with you on that.
Yeah, and I just reclaim. Oh, sorry. I guess there were people in our waiting room, and I didn't know that. I didn't get notified on those. That's weird. For those of you who just joined, I apologize. I'm not sure how long you were in our waiting room, but I did not get notified that you were there. So I apologize. We're about halfway through. We're going to cover some more information here. Hopefully it'll be beneficial for you. All of this has been recorded, and so we'll share it with everybody who's joining us so that you're aware. Right now, we're just kind of going through some Q&A over what Stephen has talked about tax-wise. What I wanted to do here, let me see if I can do this real quick. Hold on a second. Hey, Stephen, do you have the ability to unshare your screen? Oh, wait, here, hold on. I think I got it. Okay. All right.
You good now, Chad?
Yeah, I'm good.
Okay.
I just wanted to share this. This was sort of an aha moment for me a few years back. And I don't know that a lot of people understand this, but people will oftentimes ask, what income tax bracket are you in? Okay. And so I'm always looking at the tax brackets and where they are. And so this first tax bracket you see here is for a single filer. And what I don't think a lot of people understand is where it says the 10% tax bracket, what that means is, let's say you earn $100,000 a year. Well, the first $9,950 you earn is taxed at 10%. Then from $9,951 to $40,525, that portion of your income is taxed at 12%, and so on and so forth as you move up the tax bracket. And so where Stephen mentioned that a lot of folks end up, kind of falling in that 20 to 25% tax bracket, at the end of the day, not all of your tax dollars are taxed at, in this case, 24%. As you can see, anything below 86,376 was actually taxed at less than that. And so I don't think a lot of people understand that. And that's why for a lot of self-employed borrowers, particularly a lot of agents I work with, I say at the very least, if you pay quarterly taxes at about 20% of what your estimated annual income is going to be, chances are your tax bill, whatever it is, won't be too shocking at the end of the year. So I've got a spreadsheet that I use to kind of help me manage this as I move up in tax brackets. And obviously, as I tell people, my goal is to pay a lot in taxes, because that just means I want making a lot of money, right? So my goal is to hopefully keep moving up the tax bracket so that we can get into the higher income tax brackets, and in my case, everybody wins. Of course, the IRS is winning, but I'm winning too because I'm making more money. All right. Okay, give me 1 second. I'm going to share my screen, and I'm going to walk through this. All right, here we go. So self-employed income analysis. And so, and Stephen, I don't know that we've talked much about this. So if you have anything to interject along the way, by all means. And if for those of you who are on here, there is a chat box. So if you guys have questions, feel free to chime in questions in the chat box as well. Oh. All right, so real quick, as Stephen just mentioned, you can file as a sole proprietor. or you can file as an LLC S Corp. Okay, so we're going to talk to you about both of those and what those tax forms look like, so you can have a better understanding of what forms we're asking for when we ask for those things. Okay, filing Schedule C or Schedule E and 1120S. So when you file a Schedule E, the tax form you're going to ultimately file is going to be called an 1120S. A very important document associated with that 1120S is called a K1. Okay. In the scenarios we talked through today, we're working through, well, that's kind of blurry looking. We're going to be working through a particular because I want to show you all how a debt to income ratio is calculated based on a self-employed borrower. And so we're just going to be using these numbers here, a total monthly house payment of about $1,900, which I think, as we all know, is getting harder and harder to come by in Houston, unfortunately. All right, sole proprietor tax forms. Okay, so when we ask for a self-employed borrower who files as a sole proprietor, we're going to be asking for your 1040 tax return. And we will ask for all schedules. Okay, so the 1040, so when whoever prepares your taxes, whenever you print it or save it as a PDF, how long it'll be will dependent upon how many different deductions and things you file. But I would say oftentimes tax returns are going to be somewhere between 12 to 20 plus pages. Some forms that if you go and click print, it'll be 70 or 80 pages. I will tell you, if you send us 70 or 80 pages, it's not the end of the world. We're only going to use what we need. Okay. But in this case, we're looking at Mr. Bradley Pitt's tax returns. He's got a 1040 that's showing that looks like he had roughly total income on line 9 here of about $152,000. And the other important document we're going to be looking at is called the Schedule C. Okay, the Schedule C is where the sole proprietor is going to list their revenue, which here is listed as $201,000. Part 2 is going to list all of their itemized expenses. And down at the bottom is going to be their net profit, which is about $152,686. And you'll notice that this feeds over to the 1040 page. So whenever I ask my agents or clients how much did they make, I'm asking about the 152. I'm not asking about the 201. 201 is what you generated in revenue. 152 is what you were taxed on. That's what matters to me. Okay. All right, so the boxes that are important to us, you'll notice here on your 1040, we're looking at box 1 where your wages are. So for a normal salaried employee, they're always going to have something listed here. As a sole proprietor, if you have no W-2 job, there's nothing going to be listed in this box. Okay. On the Schedule C, we look at a number of different things, and there's lots of different things we're looking at. We're sort of circling in red the boxes that are sort of important to us to make sure that we're not missing anything when we're calculating your income. Because like I said, some things we have to deduct additionally, some things we have to add back. Okay. For example, the most common add backs that increase someone's income are probably depletion and depreciation. However, we very, very rarely see those for true sole proprietors. Okay. Whereas deductible meals, as Stephen mentioned before, historically, you've only been able to deduct 50% of those, which means we would have to go in and deduct an additional $508 from Brad Pitt's income because he would have only been deducting 50%. Now that it's 100% deduction, we should be in good shape with what the tax return lists. Okay. On this page, you'll see the mileage. We are allowed to add mileage back as well because that's also kind of a depreciation type of expense. So that will cause the income to go up just a little bit. And then at the bottom here, you'll see the itemization of all of the expenses. Okay. One thing I'd like to mention about the Schedule C, for most self-employed borrowers, we are typically going to be asking for profit and loss statements. Profit and loss statements is ultimately what QuickBooks will provide. So if you hired someone like Stephen to handle your QuickBooks for you, you would be able to print your P&L at any time throughout the year, and it should be pretty up to date for the most part. During COVID, they were much more restrictive as regarding what the P&Ls we had to have both the P&L plus 3 months of business bank statements. Now the 3 months of business bank statements has been waived for the most part. P&Ls will still be needed oftentimes, depending upon where we're at in the year. Right now, it's so early in 2022. most of the time we're not going to be asking for P&Ls right now. As we move later in the year, we're going to be asking for P&Ls because the most important thing we're looking for self-employed borrowers is consistency of income. And so we want to make sure that your income is stable. So let's say, for example, in this scenario, he made $200,000 in revenue last year, but this year he's only made $5,000. So he's not on pace to make $200,000 this year. That could be a red flag and a concern, and we would have to explain that. Because real estate is so cyclical, oftentimes when I'm working with real estate agents buying houses, say in May, they haven't gotten to the busy season yet, and their revenues are not projecting out correctly, and that requires a little bit deeper dive. And I'm pretty good at that, so I can work through that. I can usually tell the story to the underwriter of saying, look, most realtors earn 60 to 70% of their income from April 1 through October 31st, and those other 4 months are the slowest months of the year. So, but it just takes a little bit deeper dive. All right, so real quick, how would we calculate Brad Pitt's income in this scenario? This is sort of, let's see, yeah, this is where we do our Schedule C calculation. And you see we put his net profit here, $152,686. On line 11 for meals and entertainment, we're deducting the other $508 since it was in that particular year, I believe it was only a 50%. Was it a 50% deduction that year, Stephen, or was it 100%?
Say that again, Chad.
2021, were meals and entertainment 100% deduction? Okay,
100%
so
for 21 and 22.
Okay, 21. Okay, so this one I think we're working off of is 2020 actually.
Right.
So in this case, it would have been only a 50% deduction. So therefore, we have to hit him for another $508 on the meals because technically he spent that much on meals. You see business use of home, we're able to add that back in because that's another kind of depreciation type of expense. So we're able to add $1,000 back. Business miles, and you can see here, we're able to add quite a bit back at 27 cents a mile. So he had about $3,938 we could add back to his income. So in this scenario, we have Brad Pitt making about $157,000 in taxable income. His 1 year average is $13,093. I really wanted to keep this simple just so y'all can see how we calculate income. Most of the time we have to do a 2 year average. Okay, so we would look at both 2020 and 2021. Right now, that's what we're calculating for self-employed borrowers. In some instances where we have really well-qualified borrowers who have been in business for 5 or more years, we can sometimes get away with just 1 year's tax return, and that makes things a lot easier. Okay, but in this case, we've got about $13,000 a month. We'll show you how our debt to income ratio is calculated. I'm assuming he has other debts of about $1,100 a month. His mortgage, again, at $1,889, so his total of all of his liabilities are $2,989. He makes $13,000. His total debt to income ratio is about 22.835%. At the bottom here, you'll see we want our debt to income ratio to be below 45. In some instances, we can get on a conventional loan, we can get approvals up to 49. And then on FHA, even FHA and VA even higher than that, up to 57 on FHA, and VA is a whole different animal with lots of different other calculations. But Brad Pitt here in this case is very well qualified. All right, so then we'll transition over here to an LLC S Corp. And so in this case, we're looking for on the primary 1040 tax return. This is the personal individual tax return. You can see on the left, we have wages of about $46,087. Down here, we have other income of about $112 with total income of about $158. Okay. And then on the right, and you'll notice this is Jennifer Lopez we're talking about here, J-Lo Real Estate Inc. She has a K-1 that is producing about $112,000 of income. Okay, the K-1 form feeds to Schedule E on the tax return. So anytime I have an LLC S Corp client, I'm looking at their 1040, I'm looking at their Schedule E. The Schedule E is going to tell me there's a K-1 somewhere, and I'm going to need a copy of that K-1 plus the 1120S as well. Here's the K1 and the 1120S. K1's on the left-hand side. What's really important to me about the K1 is A, the income and or loss that may be reported, coupled with their ownership percentage, which is listed down here as 100%. So when I have a self-employed borrower, one of the most important questions we ask is, do they own 25% or more of the business? If they do own more than 25% of the business, then I know that I have to have the 1120 tax return. If they own less than 25%, I don't necessarily have to have the 1120S to calculate their income. All right. So, and then off to the right is the 1120S, and there's lots of things going on here. Ultimately, again, this front page of the 1120S is it's basically a P&L. You've got all the gross revenue listed in section 1 here as income. And then in the bottom here, you've got all the deductions, which are ultimately all of the expenses, and the ordinary business income listed at the bottom is ultimately going to be what their profit was for the business. What do we look at on the 1040? As I mentioned before, the wages, $46,000 there. Then we look in the Schedule E, where we're looking for the $112,145, which is fed over from the K1. On this page, we're looking at net gain or other income that may be listed. We're looking for the depreciation highlighted. And then, sorry. And then down here at the bottom, my screen is hidden. Okay, yeah, other deductions of $45,000. So we've got to dig a little deeper into the other deductions. Okay, on this page, this is something we always look at and we don't run into very often, but mortgages, notes, bonds payable in less than 1 year. For most people, this is really not an issue, but as we start to deal with bigger businesses, they have I'll just use myself as an example. So I'm what's called a correspondent mortgage lender, which means I have warehouse lines that I use to fund the mortgages that we close, and those renew every year. Okay, so they're fairly large lines of credit, and they renew every year. Well, the key for me is it would show on this page as an outstanding loan that's due in less than a year. Well, without knowing any details about that, we typically have to hit the client for that 100%, and that can be a real problem for a lot of people. Most of the time, it is a line of credit that is renewed each and every year, meaning we have to talk to their banker saying, yes, we renew this every year. We have every intention of renewing it every year, and then we don't have to hit them for that liability. Because if we did, if I had a $1 million line of credit there and I had to hit myself with that, then I would never qualify for a loan. And that would not be good. All right, travel and entertainment. So we look at this page to see if there's any additional expenses we have to account for on the calculation. Here's our income calculation spreadsheet. And you see we've got the wages. We have the ordinary income from the K1. And our ownership percentage is 100%. And so we've got depreciation here of about $1,875 that we're able to add back in. When we do all the math, JLO works out to about $160,000 of taxable income, which is $13,342. Her debt to income ratio is just a little bit better than Brad Pitt's, just at 22.4%. She's in great shape, very well qualified. So these are two instances of two people who qualify for a loan. Oftentimes when we get these tax returns and we work through all of the expenses, our debt to income ratio is much higher. And I'm working on a case with Stephen right now where we're actually, our income is actually fine, but it's a client who has an LLC S Corp, and we're trying to work through the best way to handle her expenses to make sure it doesn't impede her ability to do what she wants to do. So that is my presentation. Again, meant to be short and sweet. We are happy to share all of this with you. I would love to open it up for anyone that may have any questions or concerns. Let's see here. Hold on 1 second. Okay, I'm trying to figure out what I'm doing wrong here. Where am I? Oh, there it is. Okay, here we go. So Sergio asked, can you deduct your cell phone bill for the year as a realtor? Stephen,
Yes.
would you like?
Yes. Yes.
Yes. Oh, wow. Hey, we can say yes. All right, good.
We can say yes. Yes.
All right, good. I figured that was the answer, but just wanted to make sure.
Again, anything business related, and so that would certainly qualify. Not only the fees that you have, monthly fees, but if you went and bought a new cell phone, same thing. Now you may have to, in a perfect world, if you only use that cell phone 80% for business, then we would take 80% of the expense. But most of the time we don't go there. It's just full 100%.
Yeah. I'll say this, I deduct all of mine. All right. Darla says, is it better to own or lease a car in the realtor business?
Again, that would depend upon how. There's a couple of things. I mean, I know a lot of people do lease their cars. So you get on the lease, you're basically getting the monthly lease cost as an expense, which is okay. If, for example, you were going to purchase a car and it happened to be something with a gross vehicle weight over 6,000 pounds, and you wanted a big write-off in that 1 year, then I would definitely go the purchase route, because I'll give you an example. Let's just say you buy an SUV. I mean, I don't know what an average SUV costs now. I mean, I'm going to say it's probably, 50. Let's just say. I mean, that's ridiculous.
They're expensive.
Let's just say it's at least 50. And you're in a 20% bracket. So you bought that $50,000 vehicle, and I'm just making it simple. But if you used it 100% for business, and your tax rate was 20%, well, 50,000 at 20% is $10,000 of potential tax savings there. So, now that's a 1-year thing. So you'd have to ask yourself, hey, do I want to, pay less tax in this particular year? The next year, you're not going to get any depreciation, but you will get gas, insurance, any repairs and maintenance, those kind of things. So again, it depends on your situation, honestly. And some people too, they just like getting new cars, let's just say every 2 years, if it's a 2-year lease on a car. So that may deter your situation, determination of which way you want it to go. It's just remember that there is that potential big tax savings in a year, and that probably would go every, minimum 3 or 4 years that you could do that. But again, it does provide a significant tax break.
Yeah, absolutely. And I guess I would piggyback on that and say, I would say the higher your income you think it's going to be, probably the greater benefit of buying it and taking that deduction versus leasing it. And I've leased cars before, and the one true downside for me in the leasing world is you're just always locked into an expense. I will say this, and from what I get to see, those leases can really hurt the debt to income ratio, because obviously I know a lot of agents I work with have very nice cars because they're driving people all over the place and they want to have a nice car to represent it. But if you've got $1,000 a month car payment, that's going to hit the debt to income ratio very hard. Whereas if you buy a car and you pay it off over time, eventually that bill goes away and you're not stuck into getting a new high payment every 24 to 36 months or however often you trade it in. Let's see. Okay, Sergio says, what if my wife is on the same bill? Oh, it's back to the cell phone. What if my wife is on the same bill? Do I just deduct my cost? How do you handle that?
Yes.
Yes.
If you can allocate that out, yes. I mean, whatever, there's normally a rate, and then piggyback charges for family members. Take the higher rate for yourself, obviously, and your wife is on there for $20, or however that works out. But take the higher part for yourself. Put the plan in your name. Yeah.
Yep. Absolutely. All right. I don't see any more questions. Anybody have any other questions? Well, I hope that this was beneficial. We'll send out a survey after this, along with both presentations, so that you have them. Again, Stephen's presentation will have all his contact information. Mine will have mine. Regardless of what your questions are, please feel free to reach out anytime. And I'll happy to get you back reconnected with Stephen But we're certainly at that time of year where taxes are important. Tax filing due date this year is what, Stephen? 4/15?
Yes.
Back to the
Yes.
back to the old days.
If you have an S corp, it's 3/15. So that's coming up pretty quick. Yeah. So
LLC. Is that why you asked me?
That is not true. They changed that. So S corps and individuals are the 4/15. So you still have some time to get it done.
Okay.
Yeah.
Okay. So 4/15 is normal filing date.
Yes.
Otherwise, file an extension to October 15th.
Yes.
Okay. Got it. All right. Well, thank you all for joining us. We got it done in less than an hour, so that's impressive. And we appreciate you. And if there's anything we can do for you, don't hesitate to reach out.
Yeah.
So have a great rest of your day.
Okay.
Thanks, guys.
I belong to you. I belong to you.